Hi everyone! Today we're going to talk about excise taxes. So excise taxes are just a tax on a specific good. And a good example is like a tax on cigarettes or something like that. Oftentimes the government will decide to implement an excise tax on a good that they want to limit the people from buying. So, since cigarettes are bad for you, the government implements a large per unit tax on every pack of cigarettes to discourage or disincentivize people from buying cigarettes. So in the market, what that ends up looking like, we've got our normal supply and demand market for cigarettes. The tax is going to appear as a decrease in supply. Okay, so basically you're going to end up with this situation where supply is now less than it was because the government is charging this tax, and that is going to have to be paid by somebody, and so the suppliers will most likely be paying it logistically, but they won't be paying the full cost of the tax, and that's what the concept of tax incidence refers to. Basically, tax incidence is studying who really bears the burden of the tax. So in this case, the amount of the tax is the vertical distance. It's always the vertical distance between the two supply curves, okay? So you would come over here on the y-axis, and this amount right here is the amount of the tax. And so if there were numbers here, like let's say that this was $11 and this was $8, then that would mean the tax is $3 because 11 minus 8 is 3. Okay? So in terms of figuring out the tax incidence, basically you kind of look at where the old price was, the original price before the tax. The quantity is down here, okay? This was the original price, and let's say that the original price was $9.50, and I'm just going to draw an arrow in there because I kind of ran out of room. Okay, but the original price is $9.50, so that would mean that the tax incidence is pretty much evenly split between the producers and the consumers of cigarettes. In this case, because 11 minus 9.50 would be $1.50, and 9.50 minus 8 is $1.50. So these rectangles are about equal, and these rectangles are eating into the consumer and producer surplus, because the consumer surplus used to be this whole region right here, but now it's only this region. Okay, because this quantity is now the quantity that is being transacted in the marketplace. Okay, and the producer surplus has also lost. It used to be this whole region right here, but now the tax is eating into that, and so the producer surplus is only down here. This rectangle right here that I'm boxing in is the amount of tax revenue that the government is going to get, because they're getting $3, that's the amount of the tax, times the quantity that's sold. So if the quantity was 100 packs in this example, then the tax revenue, if this was 100, tax revenue would equal $3 times 100 packs of cigarettes, so it'd be $300. And then this triangle right here represents the deadweight loss, because this is the value of transactions that are no longer taking place. This is the new quantity. It's less than the original quantity, and so if you needed to, you could find the area of that triangle if you had the appropriate numbers. So let's say this quantity was 150. So the formula for the area of a triangle is 1/2 base times height. So basically, you've got 150 minus 100, which is going to be 50. So you can just cut that in half and take 25 times 3 to get $75 as the area of this triangle, or the value of your deadweight loss due to the excise tax on cigarettes. But in this case, it's probably a good thing since cigarettes are very bad for you. So thanks for watching today. Have a good one.